Hello, hello. Hello.
Hello.
Yeah, can you hear me, Asanga?
Yes, I can.
Right. Can you see the screen also?
Yeah, I can see the screen. I'm
Right.
so sorry.
Uh,
Normally, I'm using office laptop, and today, I didn't bring that home yesterday,
all
so I'm
right.
using
Okay.
the one at home.
Right.
So it's giving problem.
No problem. Don't worry. So I think, so long as we can see the screen and
Yeah.
so long as you can hear me on Skype, we should be able to do a little bit of work.
Okay.
Yeah. Right. So yeah, let's what I thought was we will start the first lesson on the traditional costing. As we go along, we will learn a lot about the modern costing techniques, but still for all, the old costing system, what we call the traditional costing system or the absorption costing system, still prevails.
Yeah.
And for our accounting purposes, the inventory valuation, still we go by the absorption costing system. In fact, what we call the total costing system. So let's
Yeah.
discuss something about little bit about the costing. What is costing and what for? Mhm. Why do we need costing? Because actually, the history of SIMA, they first started. They said the Institute of Cost and Works Accountant. Then later on, they become Chartered Institute of Cost and Management Accountants. Then they become Chartered Institute of Cost and Management Accountants. So originally, SIMA was specialized in cost accounting. So what is the purpose or why do we need costing?
Um, we, yeah, if we selling product
Yeah.
or service,
Mm-hmm.
we should know the cost.
Yeah.
Then, then based on that, we can decide on the selling price.
Yeah, right. Yeah. Yeah. Because, you and I both belong to the traditional school. So we tend to think that with the cost, that was our original way. We look at the cost and then, we can put up our profit margin and we can decide our pricing. But actually, today in the modern world, the things have changed a lot. We can't simply decide the pricing because the market is so competitive. There's already a price decided by the market for your product. But still for all, we need costing to know our cost and to see whether we can sell at that particular price, the market price, and whether we can make a profit.
Yeah.
So actually the modern costing is something called target costing because the market has already decided the price. Earlier what we did was our accountants, the cost accountant will do the cost and say it's $100. Then you add up a 20% markup and then we say, okay, this is the selling price and go and sell it at that price. But
Yeah.
today that era is gone because the market is very, very competitive. There are many people who are in the market who are prepared to give it at different prices. So you can't dictate the price unless you have a monopoly.
Yeah.
So that because of that only the new changes have come up mostly. But as you rightly said, it is necessary for any product or service what we are doing, we need to know the cost. And why we need to know the cost, number one reason, still for all, with all the new developments, everything, inventory valuation, we need to know the cost. So that's the first reason why we need to know the cost to value the inventory at the end of the year. We need to know what is the cost per unit, how many units are there in stores, and that's the value of the closing stock. Then we need to know the cost to record the cost of sale. Right? So if we know that he has sold 100 units and if the cost is 80, we know 80 into 100 is the cost of sales. So to record the cost, we need to know the cost. Then, of course, still for all, to price the product because we need to know the cost to price the product. Market may decide, but whether we can sell it at that price, all that we will need to know the cost. And
yeah,
today in the modern world, we need to know the cost for many other decision making. Sometimes when you go to a shop and when you try to bargain with the shop owner, he might decide to sell it below the listed price because he can make a decision because he knows his cost is so much.
yeah,
Particularly when you go to countries like Singapore and Bangkok and all that places, we know how to bargain it. And that fellow knows his cost, so he says, yes, okay, you buy it. That kind of a situation. So we basically need the costing for many purposes, and some of the key purposes is the inventory valuation, to record the cost, to price the product, and to make decision making.
yeah,
So this can be a simple short question, objective test question coming up, the purposes of costing. So therefore, we need to know the cost per product or the cost of services or whatever it means. So next question is how to calculate this cost. So we know when it takes the cost, there are certain behavioral aspects of costs. Certain costs are directly related to the activity level. What I mean is, if you are producing 1 unit, you will need 2 kilograms. If you are producing 2 units, you will need 4 kilograms. If you are producing 3 units, you need 6 kilograms. So that is directly in proportion to the level of activity or the volume, the cost, and those costs are what we call the variable cost. Traditionally, we thought even direct labor as a variable cost because most of the time earlier, I suppose the people are paid on the piecemeal basis according to the number of units they produce. But today, very much the labor has become a more of a fixed cost because whether you produce or not, the various legislations, regulations uh, uh, dictate us that we have to pay a permanent salary to our workers
yes,
minimum. So because of that, the labor, although earlier we thought it is a variable, now it has become more of a fixed cost. But still, for all, for our accounting purposes, we consider most of the time labor as a variable cost. Then we have certain overheads. So the material and labor are basically very direct kind of cost, even in the traditional model. Then we have the overheads. Overheads are the kind of cost that is not moving with the level of activity, with the level of some, at least some overheads. So the overheads also we can categorize it into two categories. One is the fixed overheads, the other one is the variable overhead. So the direct
yeah,
material surely is a variable cost. Direct labor still for us we consider it as a variable cost. What is variable cost is it moves with the level of activity. Then we have sometimes the variable overhead. They are not material, they are not labor, they are a kind of other expenditure but moves along with the level of activity. Maybe the machine, running cost, the fuel. The more you run the machine, you need fuel, and that can be a variable overhead. But then there are certain other costs, what we call the fixed overheads. What are they? They don't vary with the level of your output or activity. For example, the rent. Whether you produce 1 unit or 2 units or 100 units, your office rent will remain same, right? At least up to to a level. The warehouse rent will remain same up to a point. So these are what we call the fixed overhead. So if you really look at the total cost is made up of all these things together. So these costs, no problem. We can find out per unit, okay, 2 kilograms, 5 hours, whatever it may be. Variable overhead is also possible. But the fixed overhead, it's not that easy. We have to allocate it or apportion it amongst the many output that we produce. And it becomes further complicated when you are producing different kinds of output. Today in the factories, it's not one particular product that is they are producing, they produce many products. So how to apportion that overhead cost? This is your big problem, and this is all our traditional costing is all about. Yeah.
yeah,
So So the cost behavior, as I said, there are one, two, three, four. The fixed cost, it will remain fixed. Example, rent, that kind of thing. Factory supervisor salary, those are remaining fixed irrespective of the level of output, at least up to a certain level. Maybe when you reach a certain thing, you have to go for another new factory premises or another new machine or something like that. The variable costs are basically the things which varies with the activity, direct material, direct labor, variable overhead. So generally the variable costs move in proportion to the activity, and generally we call it a linear cost. It goes in line. Some variable cost may be not linear, but that is mainly due to the what we call economies of scale. Now that is also a very important one. When you produce one unit, maybe you need 2 kilograms, and at the rate of 10, it will be the total cost is 20. When you are producing 2 units, you will need 4 kilograms. At the rate of 10, it will be 40. So per unit cost is 20, here also 20, here also 10. But when you are producing 10 units, you will need 20 kilograms, but the cost can come down because you are buying bulk quantity. It may come down to 950. And that is what we call the economies of scale. So that one, that will make it 190 your total cost, 950 to 20. And that means your cost per unit will come down to 19. So this is what we know as economies of scale as you go on producing. So even though the variable cost is sometimes considered to be linear, it can come down like this. So these little things, sometimes in the examination questions, they might ask you, we need to know that kind of a thing. And then there are certain costs, what we call semi-variable costs. A part is fixed, part is variable. Mostly, I'm not sure in the UK, but most of the places, uh, if you look at the telephone or the internet, they give a particular number of GBs fixed for your monthly
Yeah.
rental. And beyond that, you have to pay additional cost. So part up to that point, it is fixed. And beyond that, you have to pay something more. So up to this point, it's fixed. And then beyond that, according to your consumption, you will have to pay. So that there, so there you have the cost is behaving in two ways. A little, but not a little part. A part of it is fixed. A part of it is variable. Then we have a step up cost. What is step up cost? Up to a particular, maybe up to 10,000 units, you can use the same premises. And then the moment you exceed the 10,000 and go to the 10,001 unit, you have to step up your cost. So it goes like this. It's not linear. It goes up in steps like. So that's a kind of, so these are the type of cost that we find in our cost behavior. This is applicable with even with our modern costing techniques. We have to really understand the cost behavior, fixed variable, semi-variable, and step-up cost. These are the four types of costs that we have. So now let's come to the absorption costing. So the absorption costing, the basically the aim objective is to determine the full production cost per unit. So if you are producing this particular output, the full production cost per unit will be the direct material, whatever the labor that went in, whatever the overheads that were directly attributable to this, plus a proportion of your fixed overheads, what was absorbed to this one. And that is what we call, you have to remember, this is your total production cost. I want you to be careful here. Just because we have got the total production cost as 100, that is not the end of your costing. Because to sell this product, you need to incur something called selling and distribution, maybe another 15. That is after production. To sell it, you need to do it. Maybe advertisements, all that. And there is some administration involved, and that also you will need another 10. So the total cost is 125. Total production cost is 100. but the total cost is 135. So examination questions, we have to be very, very careful with this, particularly with the objective test questions. The land weight, when they say total production cost, total factory cost, total cost, all that we need to be very, very focused, because we might miss that little word and we might go and, put the wrong answer. So here we are focusing on production cost. So production is direct materials, direct labor, the variable overheads, and the fixed overheads attributable to the factory. So now I'm looking the red line. The red one is the total cost, and the total cost is made up of production cost plus the non-production cost. So the example what I worked out, the production cost is 100, non-production costs are 35. That is what the total cost will be, 135. So this production cost is made up of three components. Direct prime cost. Direct prime cost is basically the material and labor. That is what we call the direct prime cost. So production costs are made up of direct material, direct labor, and production overhead. And to add to that, you have to add this 35, get your total cost, and with the total cost only, you must compare your selling price. Okay, you can sell it at 175, then you are almost guaranteed a $40 profit.
Yeah.
Right? So you must recover the entire cost on the long term. But sometimes in decision making, you might decide, there is no market, the products are not moving. My total production cost is 135. Uh, Whatever it is, there can be, you can see the non-production costs are there, and therefore let's sell it even below our total cost. You can have that situation. So that is where the decision making will come and decide. And for that to happen, you must know your costs in very detail. What are the variable costs? What are the fixed costs? What are the non-production costs? What are the total production costs? All that. So this is why costing is so important for us to know, because we have to make lot of decisions. The management will have to make decisions at various points. So now we come to that all important overhead absorption. So the overheads. So overheads may be for your factory, the overheads, it can be rent, it can be your factory supervisor's salary, it can be your electricity, and like that many other items, maybe total overheads are 100,000. So if your total overheads are 100,000, and this 100,000 need to be absorbed or charged to your production. So if you are producing one simple product, let's assume that you are producing one single output, 10,000 units. Very simple. We know the total overheads are 100,000. The number of units are 10,000. So we can absorb for each unit $10. Very simple. We know the total overheads are 100,000. We are producing 10,000 units. Absorb it at the rate of $10. You have covered up your cost. But today we live in a world where very rarely we will find a factory producing one particular item. Factory will produce many items. So then of course you have a problem. You can't divide it by the number of units. So one way that what we can do is we can go with the traditionally most of our factories were labor based. So we used to go with the labor hours. So the assumption was the more labor hours you use, the more the overheads are. Right? For example, if you have a canteen, the more laborers you have, the canteen will have more expenditure. So what they thought was, okay, 100,000 is the overhead, 100,000 is the overhead. The workers have worked 10,000 hours during this particular 1 month or 1 year or whatever, and then they will say the overhead absorption rate is 10, the 100,000, sorry, well, let's assume 100,000 is overhead, and let's assume, yes, 10,000, then we will say per labor hour the overhead is $10. per labor hour. So you're producing something which is going to take 3 labor hours. So then you will charge $30 as overhead. So maybe that a particular product, the direct materials they are using, let's assume 2 kilograms of whatever the raw material, and let's assume the raw material is going to cost you 20. So 20 into 240. Let's assume that the direct labor it's going to take 3 hours, and each labor is paid $5. So
Yeah.
15, and then we say, okay, this product is taking 3 labor hours. That means the overhead absorption rate is 10 per labor hour. So we will add up for labor, sorry, for the overheads, another 10, another 30, and then we will say total production cost is 85. So this was good enough when the labor was the labor, most of the industries were labor intensive. And that was the story maybe 50 years back. But today, it's somewhat different. Today, most of the time, we use machines, not labor. Actually, if you really look at it, more than machines, today we use technology. But 20 years back, it was mostly machines instead of labor. So instead of taking the labor hours, they started taking the machine hours and working hours. So the total 100,000, you will want to divide it by the number of machine hours. So maybe during this period, 20,000 machine hours are run. So we will say $5 per machine hour. So for the particular product, okay, how many machine hours did it incur? At the rate of 5 machine hours, 5 into 5, 25 is your overhead cost. So that to that one, we can calculate the thing. So basically, it was connected with the volumes of production. Sorry, it was connected with the thing was connected with labor hours or the machine hours or whatever it is. But one thing, you can do this one, but to do this thing, you have to, if you have to wait till you know the actual overheads of 100,000, it will be useless. Why? Because by the time you do the costing, the product will get rotten or whatever, because your accountant will be able to tell you the actual overheads only at the end of the month.
Yeah.
And if you are going to do the costing at the end of the month, the whatever you produce on the first of the month, second of the month will get damaged or perished or rotten, because you are waiting for the costing to get the true costing till the end of the month. So because of that, what you do is we go by something called predetermined overhead rate. We budget the overhead. We budget the production number of units or whatever. And then we absorb it based on predetermined budgeted ones. The reason, number one reason, you can't wait till the actual costing comes, it will be too late.
Yeah.
Number two, you even with actual costing, you can't be changing the costing figures every month, because there has to be some stability, because particularly the traditional time, we look at the cost and fix the price. So in that case, we'll be looking, oh, this month 100,000, the cost should be 80. Next month 120, the cost should be 90. Next month the cost is the overheads have come down to 70, cost should be 70, something like that. If you're going to do that one, the prices will fluctuate, and that's not good for a business.
Yeah.
So you have to maintain some price stability. So for that purpose, we generally go with, not generally, we always go with predetermined overheads and predetermined production levels or labor hours or machine hours. And therefore, the overhead absorption rate is a predetermined rate, a budgeted rate. But invariably, when you work out with the budget, what is the problem? The next problem we face. The next problem that we face will be, we will be having some under absorption or over absorption. Now this is a big problem, right? We budgeted for 100,000, for example, and we thought that we are going to produce 10,000, and we will absorb it at the rate of 10 per unit. But we might find The actual overheads are 120,000. Okay, let's assume that we produce the 10,000. Then at the rate of 10, when we absorb, we will absorb only 100,000. But the actual overheads are 120. So there is an under absorption of overheads of 20,000. So this is a problem. This is a big problem with the traditional, because when we do with the predetermined overhead rates, we can always have an under absorption situation, or we can even have over absorption situation. We budgeted for 100, but the actual overhead is only 90,000. But when you go on the basis of $10 and absorb it into the 10,000 units, we will absorb 100,000. So we have absorbed more than our actual overhead. So that adjustment we have to do it at the bottom of the P&L, because we have to always work out the under absorption or the over absorption at the end of the period, and then find out the true profit or loss.
Yeah.
So that's a little bit of a complicated calculation that we will come across in our P1, the under absorption and over absorption. So the overhead allocation or the apportionment, we have to decide a particular method. So as I said, if it is one particular product, the simplest way is the number of units. But if the organization is more labor intensive, we can go with the labor hours. If the organization is more machine intensive, we can go with machine hours. So this was the traditional method we used it. And generally, those days, I mean, in the traditional era, the direct materials will cost you 40, direct labor will cost you, let's assume, 30. Your overheads will be 10, little compared to these two items. So, yeah, this is very direct. This is very direct. So this is the only one we are going to do it in a very subjective basis, either based on direct materials or direct labor hours or whatever. So a little proportion of your total cost, maybe less than 10% or maybe 12%, will be something that can be erroneous. 70 is very right cost, because they are very accurately measurable. But that overhead apportionment, it can go wrong little bit here and there. That was all right because it was only 10. But today, if you really look at today in this modern era, it's totally a different story, because we don't we use very little labor. So the material may be still 40, but labor may be 10, and the overheads may be 30, because you are using lot of computers, lot of technology. Look at two of us, we are using the computer. Hmm.
Yeah.
Most of our expenditure is the overhead today, right? So it's basically the overheads have become very big. And now, if this cost is not properly correctly attributed, you may get wrong costing, and your accountant may say it's costing 80. But if you really do a very, very accurate costing, you might find the overheads are not 30, overheads are only, 15. So your accountant will say cost is 80, and so you will fight saying we can't sell it at 80, we can't sell it at 100, this, that, and the other. But if you really go and do a very detailed costing, you might find it to be 50. And you might lose a big order because the accountant was so stubborn to say that it is 80.
Yeah.
Right? So this is why we have something called new thing called activity-based costing coming up, because overheads are becoming very big, overheads are becoming very prominent, and therefore we need to have a better method of allocating a portion in overheads, and that's our next chapter. It's all about activity-based costing. But for the moment, still remaining in the traditional costing, I told you we can apportion it, the overhead, either on the number of units produced, or the number of the labor hours, or the number of the machine hours. Now, what is the assumption there? The assumption is that all your overheads are moving in proportion to the number of units, or in proportion to the number of labor hours, or in proportion to the number of machine hours. Yeah,
Yeah.
that is the assumption. But you and I know that is not really correct. Some of the overheads are not moving in accordance with the number of labor. For example, the rent will not move with the labor.
yeah,
The electricity may not move with the labor. So most of the overheads may not move with the labor. And to assume that everything is moving with the labor hours and to charge it is not right. So these are the problems that we face with the traditional costing. But still for all, this is the method, but we have to use it because IAS 2, the International Accounting Standard for Inventory Valuation, they talk when they are valuing the inventory, they say the inventory should be valued at total cost, at least total production cost. So total production cost means direct materials, direct labor, and overheads apportion. So we can't get away from the traditional costing. So long as IS2 is there, we need to work out overhead based on this one.
mhm,
So this is why still I think we need to know this one. It's more relevant for us. So however, the absorption procedure, so it's a complex procedure. It goes through three stages. First stage, we have to allocate all the overhead to various cost centers. So the cost centers are basically in an organization. The finance division is a cost center. Maybe your product manufacturing division is a cost center. So you have to charge every cost, electricity, rent, water, depreciation on the machine, factory supervisor salary, because there none of them are moving with the level of activity. You have to charge it to the particular cost center. Human resource salaries must be charged to the human resource cost center. Finance division should be charged to the finance division cost center. Finance division rent should be charged to the finance division cost center. But ultimately, all those costs we have to recover from whatever the product that we buy, sell.
yeah,
They are not directly attributable to the product, but still for all, we are in the business of selling some product, maybe shoes. To manufacture the shoes, we need the leather, we need the labor, all that. But in addition to that, to manufacture and sell the shoes, we need to have the factory, we need to have a CEO, we need to have a CFO, we need to have the advertisements, all that. All those are cost centers. We have to recover everything. So first thing, charge every expenditure to relevant cost center. And then all those cost center costs should be apportioned on some basis to the various production departments. You may be having ladies' shoes and gents' shoes. So all those costs must be apportioned on some basis for the ladies' shoes department and the gents' shoes department. And having apportioned all that cost to the gents' shoes department, the gents' shoes department cost will have to be absorbed by the unit of the shoes. The number of units that we have produced should be absorbed in that one. And that is how we will get the cost of production of shoes. So you can see it's a very, very complicated one. Today, actually, we are much blessed because we have lots of computer software, all that, we can do it. But I remember the time that I was doing work in the company, it was a very tedious task, little calculators we had, and we had to do all these calculations, costing. You have to have the Panadol and the Disprin standing by your side after doing all the calculations. But today, of course, with the Excel worksheet, you can just put it up and get your figures out.
yeah,
So, but still for all, you need to do it very intelligently. So when you're allocating, you can make mistakes. You can make mistakes because the electricity of the finance division can be wrongly allocated to the HR division. It can happen. Then when you're apportioning, you can make mistakes. Maybe that you have to apportion the rent based on the flow area. So the flow areas may be wrongly measured or whatever it may be. And then when you're absorbing, you will absorb it looking at the either labor rate or the machine rate or whatever it may be or the unit rate and all those things can be very, very sub. And ultimately, what we get as total cost could be not be the right cost. This is the problem. But still for all, nothing, something is better than nothing. So still for all, we have to do it, go on improving it all the time. So the overhead absorption rate, as I said, if you are producing one single product, so that is also very important. Examiner might say that the company is producing one single item. You don't need to worry about the labor hours. You don't need to worry about the machine hours. Simply take the predetermined production overhead. Simply take the predetermined number of units, divide it, you get your weight absorption. But if you are producing many types of products, ladies shows, gent shows, children's shows, etc., you may have to go by direct labor hours or machine hours. The lady shows may take more labor hours than a gent show, right? They are more sophisticated. So you might need more labor hours allocated and absorbed into the lady shows than the gent shows. So you can calculate the overhead absorption rate taking the actual figures. But as I said, if you want to take the actual figures, you have to wait till the end of the period. Imagine that you are doing some costing for a vegetable processing company. And if you are going to wait till the end of the month, till 31st December, so for you to give the vegetable cost, you know, your vegetables that came into your stores on the first, second, third, all will get rotten by the time the accountant gives you the cost. So that you can't do it. And the other thing is, as I said, you don't want to do it every month, the costing change in figures because that can upset the market. That can create a lot of confusion. So at least you try to keep the cost as the predetermined cost stable, maybe for 1 year, maybe for at least for 6 months. So the because of that, the predetermined rates will be used, and when you use the predetermined, there can be this over or under absorption happen. So that can happen, and the overhead rate is calculated, overhead absorption rate is calculated actual number of units divided by actual overhead, right? So that is what we do, overhead absorption rate. Overhead absorption rate is calculated, and then to apportion that overhead, what we do is, okay, overhead absorption rate is $10 per unit into the number of units. That is, if they have produced 10, if it has taken 10 units, then 100 will be absorbed. That's all you will do. So basically, this is uh, the thing. So what are the advantages? So basically, the advantages is uh, fixed cost can be a very substantial portion of production cost, and therefore we cannot ignore that one. And these things should be absorbed, right? So fixed production can be a substantial production a portion of production cost, and if these costs are, because later on we will learn something called marginal costing. In the marginal costing, they don't absorb the overhead. They don't absorb the overheads to the product. They just take it as a time cost and they charge it without absorbing it to the product. So if you do that one, you will not reflect the true production cost in your uh, unit cost. And also, when you absorb, what happens is, let's assume that your direct material cost is 40, direct labor cost is 30, and your overheads are absorbed 10. So your total cost is 80. Now let's assume that you produced 10,000 units and you sold only 8,000 units. So there's 2,000 left over. 2,000 left over. So you're going to value this 2,000 at the rate of 80 into 2,000, which is 160,000. So when you value, what happens is the 10 overhead, 10 into 2,000, 20,000 overhead is carried forward for the next period because that is carried in the closing stock, because we are charged that overhead and carried forward to the next period. So even though we have incurred, maybe that we have incurred 100,000 overhead, 10 into 10,000, 100,000, we are only going to charge 80,000 for the current period, and the 20,000 we are going to carry forward for the next period. So this is very much in line with the accruals concept or the matching concept. Because what is not sold, we don't want to show a cost, right? Because we sold only 8,000. So on the 8,000, yes, we will recover the overhead. But the balance 2,000 we have not sold. So we should not charge that to the this year's P&L. And by taking it into the inventory, we carry it forward for the next year and it will be charged for the next year. So that goes along with the sound accounting practices which we are supposed to maintain all the time. Right?
Basically, it's showing in inventory, that means closing stock
Yeah,
and not charging to cost of sales.
exactly.
Okay.
Exactly, because you don't want to charge it to the cost of sales because it's not because the cost is incurred, true enough, but it is the goods are not sold and
Yeah.
therefore it will be sold in the next year and we want to recover that cost in the next year.
Yeah.
That's the argument, right? So that's the argument. So that is why we carry that in the clothes in stock. So that goes aligned with the matching concept because when you remember when you're talking about the cost of sales, what we are doing is we are matching the cost with the sales,
Yeah.
but is sold. Sold is 8,000. So we want to recover, we want to match the cost with what is sold, the 8,000. So the balance 2,000 not sold, that overhead must be carried forward. Surely the material and labor we are going to carry forward, no problem. But the overhead, the marginal costing will charge the entire 100,000 for the same period. So that is why we take it up,
Yeah.
right? So then the other one is the inventory. The IS2 says inventory need to be valid with fixed overhead. And this is facilitated by absorption costing because we charge the overhead also into the total cost. And also the overabsorption, underabsorption will tell us the whether we are efficient because now we were to recover we thought we are going to spend 100,000 and we are going to produce 10,000, so the overhead absorption rate was 10. But we might find when we absorb it, the total overheads are 120,000. So when we absorb 10 into 10,000, 100,000, there's another 20,000 which is not absorbed. And that might throw out and tell us there's something wrong with our cost control. Immediately, the moment there's an underabsorption, it can be due to poor cost control because the budget was 100, but you have spent 120. So that is immediately thrown out and it might throw some light why it is so. Or it may be that your 100,000 you have incurred. You have incurred exactly 100,000, but you did not produce 10,000, you produced only 8,000. So at the rate of 10, when you recover 8,000, you recover only 80,000. But your actual overheads are 100. So that means still you have a 20,000 under absorption. Reason? Not the poor cost control. Reason is inefficiency. You did not produce the budgeted number of output. So it will really show that, either poor cost control or inefficiency. It can be the other way about also. It might be good cost control and good efficiency. It can happen. So
Yeah.
generally, even though I said there's something called a fixed cost, generally it is believed what is called a fixed cost is fixed only for a certain period. Because we know if we don't need that big rented premises, maybe after 5 years when the lease ends up, we will go for a smaller premises. So in the long term, it is assumed or it is accepted that all the costs are variable. Even in the short term, it may look way fixed because you may take a factory supervisor. You might find that fellow is not fully utilized. You might think of taking a half a fellow. a fellow not so qualified. You don't need that kind of a person. So in the long term, generally it's considered all the costs are variable cost. So that is also just an idea of the cost behavior. So these are the good objective test questions you might get it in your paper. So what are the disadvantages of absorption costing? So surely I'm sure you have it in your mind already few things. One is the apportionment can be very arbitrary. And this is very, very confusing. People will fight when you try to apportion it. I remember I was trying to apportion the canteen cost based on the number of people in each division because in the I was working in the water sector, the National Water Board. So huge canteen cost. I was trying to portion it according to the number of people in each division. Finance division 100 people, HR division 200 people. So I said the ratio should be 2:1. But the HR manager said, I don't want your canteen. Yeah, my people are not going to your canteen. My people are not patronizing the canteen. So very, very difficult to do the allocation. When you put it up on the flow basis, he says, I don't want this flow. You have given me this flow area. I don't want it. I can make it smaller. Right? So that can become very arbitrary and all that kind of a thing. And the profits will vary with there can be a manipulation of your profit through this inventory calculation because you can produce, and you don't sell it. You keep it in the closing inventory, but you can show a bigger profit because all your expenses are still in the inventory, and it will be in the inventory forever. I remember this was the story at a particular place. Uh, they were showing big profits because that man was getting some. The director in charge was getting some bonuses every month on his based on his profit. So he was showing big profit, but I found he's running into huge liquidity problems. He can't even pay his salaries, but this fellow gets a big bonus. So I checked it then to see what they were doing was just producing little sales, everything in the inventory, and all the overheads are carried out in the inventory. So that way you can manipulate, and by producing more fixed overhead in production and extra output in not sold, they will be carried forward as inventory. So you build up inventory and build up profits, and that profit will never get realized. Ultimately, one day you will have to write it off. So this the absorption costing will encourage managers to overproduce, not in line with the sales, not in line with the demand for the product. They will just try to overproduce and to inflate the profit. So that can be another problem that you and I may face it in. So these are the real practical problems that we will come across. Now I come to a new subject, talking about the marginal costing. So remember, we were talking about the cost behavior. We said the direct material, direct labor, and the variable overheads are all moving with the activity level. Fixed overheads are not moving with the activity level. So this marginal costing, when they look at the total cost, they don't look at the fixed overhead because they consider whether you produce or not, the fixed overheads are incurred. In the traditional costing, we assume fixed costs are incurred to produce. Here what they say is no, no, no. Whether we produce or not, the fixed costs are incurred. And therefore, it is not part of inventory cost. It is not part of your uh, that can be carried forward for the next year. That must be charged to the P&L this year, the fixed overhead. So in the marginal cost in the inventory valuation, you don't put the fixed overhead. You value it only on the basis of the variable cost. So there, basically what happens is we don't have the fixed overheads in your total production. Fixed overhead is considered a kind of an expenditure that is incurred irrespective of production. and charge to the P&L in the same year. So that's what the marginal costing is all about. So basically, uh, you don't only the variable costs are charged to the products or services. Fixed costs are treated as a periodical cost. So you in the early example which I was talking about, your fixed cost, the material cost was 40, labor was 10, labor was 30, and we were charging the fixed overheads 10, and we said 80, and we went on produced 10,000 and sold 8,000, and we carried over onto the this thing the 2,000 we carried over as inventory at the 80, 160,000. That was the traditional cost. But here we will take the 40, we will take the 30, but that 10 is not considered. So 10 into 10,000, what was incurred, 100,000 will be charged to the P&L straight away. Right? So you don't charge 80,000 because your inventory will be carried only at 70. So your inventory will work out at 70 into 2,000, 140,000. So now itself you can see what's going to happen. Your closing inventory and the traditional will be 160, and the marginal it will be 140. So because of that you will have an extra 20,000 profit here. Here you will have a 20,000 profit because your overheads are only absorbed 80. But here the overheads are absorbed, entire 100,000 is absorbed. So your marginal cost in profit will be lower than the absorption cost. What is the amount by lower? It is lower by that number of units, 2,000 units, the closing inventory, or the difference between the opening and the closing, 2,000, into the overhead absorption. So this is another area that we will look at some questions later on, where they will examine, might give you the marginal cost in profit and ask us to calculate the absorption cost in profit. Or he might give the absorption cost in profit and ask us to calculate the marginal cost in profit. So the two systems of costing will give two different profits, mainly due to the change in the inventory. If both the setup has sold the entire 10,000, the profit will be the same, because here also it will be 100,000 absorbed and here also 100,000 absorbed. So the profit will be same if there is no change in the inventory. But if there is inventory change, the profit between the two will change. And the marginal cost will comprise direct materials, direct labor, and the variable overhead. So what is marginal costing? Is simply the extra cost that has to incur to increase the production by 1 unit. Extra cost that has to be incurred to increase the production. That is the variable cost. That is the activity. With the level of activity, your cost increasing, and that is what we call the marginal cost. And generally, that is the variable cost. Okay, so now let's talk about the advantages of the marginal costing. It's a very simple, because you don't have that problem of apportionment and absorption. I like this marginal costing because I don't have that headache of apportioning the overhead and fighting with the managers. I don't have that problem when you go on the marginal costing. So that's a big advantage we have. It reflects the real cost behavior, because the variable fixed costs have nothing to do with the production, nothing to do with the activity. So you should not relate it to the activity. That is the argument. And when the sales increase, cost increase only by the variable cost, because the fixed cost is same. Marginal cost is more relevant for decision making, because you can see, okay, 40 direct material, direct labor 30, 70. So long as you recover 70, and if you can sell it even at 90, you will recover 20 to recover your overhead. Maybe your true selling price is 120, but if you don't have a market for 120, at least sell it at 90. At least you recover something towards overhead. If you don't do that one, you don't recover anything, you will end up with a bigger loss. But you should not never sell below 70. If you sell below 70, you are in real trouble because you are not recovering even your variable cost or the cost that is moving with the activity level. So it is more relevant for decision making in short term, which is a very, very wonderful tool we have. Disadvantages: when the fixed costs are very high, comparatively high, you tend to ignore that one. So the people, the I had a problem with this one because the when you give the marginal cost, the production fellows are very, very happy. Hey, our cost is only $25. And when we sell for $40, they think they are making a big profit. But they don't realize that there is something in the fixed overhead they need to recover. So they might lose track of that fixed overhead because it is not charged to the production cost. And therefore, they may not have the full cost information of the product. It's good for short-term decision making, but surely it is not good for long-term decision making, right? So direct labor being treated as variable cost also is something arguable because that is why now we have a new type of accounting called throughput accounting. Only the material cost is considered variable because those days direct labor was variable, but nowadays direct labor is surely not variable because the government regulations, union regulations says we have to pay the minimum salary whether we produce it or not. So we can do a reconciliation between the two statements. So I just put up this statement for you to understand it. So you can see the left side is the absorption costing, the right side is the marginal costing. Start with sales. Then as far as the absorption costing, it is cost of sales. So the cost of sales is opening stock production less closing stock, and all that cost of sales is valued at total cost. So this opening stock will be valued at total production cost, production at total production cost, closing stock at total production. So you might have a under absorption or over absorption. Then you get the gross profit, selling administration, you arrive at your net profit. But on the marginal costing, we value it, we go only by the variable cost of sales. So the opening stock is valued at variable cost. Variable production cost, closing stock at variable cost, that is what we call the marginal cost. Here you can see the part of selling expenses also can be variable. That is also put on top and we arrive at something called contribution against the gross profit here. Then what you deduct is all the fixed costs. Production fixed cost, selling distribution fixed cost, you will arrive at your net profit. So if there is no inventory change, if there is no closing inventory, the two figures should be the same. But if there is going to be an inventory change, the figures will change. Figures will change. So that we will be looking at certain questions. So the profit reconciliation is mainly due to the two methods of valuation of inventory.
So basically,
Mhm.
we have to remember, I have to remember that format.
That's correct. Yeah, yeah. Don't worry, but when we do some questions, you will remember that one.
All right.
Right? We will be looking at some questions. We will remember that one. But we're trying to get because actually you don't need to worry about the formats in the short question. You need to know how to calculate the profit reconciliation, all that. So the profit reconciliation arrives mainly because of the two methods of inventory valuation. In the absorption costing, it is total production cost. In the marginal costing, it is the variable production cost. So because of that one, there can be a change in the profit figure, and therefore we have to look at the if there is no change in the stock, it should give same profit. But if it is going to be inventory changes, then we have to work out the inventory change 2,000 units into whatever the overhead absorption rate. Okay, 10. That will be the difference between the two profits. So if the examiner says the marginal cost profits are 140 and they have a 2,000 closing stock, 10 into 2,000 added up will be your absorption costing profit. So don't worry this one. I will look at some questions with you to explain this part of it. So whenever what you need to remember just one thing, if the between the opening stock and closing stock, if there's an increase, absorption cost in profit will be more. Just remember that one. Between the opening stock and closing stock, if there's an increase, that is the closing stock is more than the opening stock, then the absorption cost in profit will be more because you're going to carry more overheads in the closing stock. If the opening stock is less than the closing stock, the marginal cost in profit will be more. So just note down that one, but I'll explain this one when you're doing the question.
Okay.
So that's the only thing because it's only a timing difference that we have. And so basically your pricing strategy is based on cost. So as I said, actually this is somewhat outdated today, but still for all there are some companies using this one, what we call cost plus pricing method. You arrive at your total cost either way, add up a margin to arrive at the selling price. So that's the normal traditional way what we did the pricing. So of course, this selling price will be somewhat influenced by the market. How much is the consumer is willing to pay? What is the level of competition? And what is your objective of marketing strategy? So basically, monopoly organization, surely they can go on the cost plus basis. But the competitive industries will have to look at the market price, but they can't just ignore the cost. They need to know the cost. Otherwise, they'll be selling, making losses and losses and losses. So the pricing strategy, cost plus pricing strategy is still relevant, but not so much in the sense, I mean, but you need to know because then only you can work out your management backwards and try to see what it can be done. So full cost pricing, you have, so what is full cost is another thing. So it can be the total production cost. It can be total production cost plus administration cost and selling cost. So that also you have to look at the examination's question and see what is his version of the total cost. So when you say normal total production cost, it is the factory cost. That is the direct material, direct labor, factory overhead. But when you say total product, total cost, it includes selling and distribution and admin cost also. So you have to remember the cost different things what you can have. So advantage of full cost pricing, surely we know it will if we can sell it at the full cost plus our profit margin, we are sure to get our targeted profit. And with that kind of thing, we can delegate it. We can tell the fellows, okay, you sell it at this price and you will get it and you can justify. And sometimes it is easy to justify the selling price to customer because you can tell, look here, this is what it's going to cost us. But not everyone will tell the truth, but at least you have something to say about the cost. But the problems with full cost pricing is the overhead apportionment can be very subjective and markup can be very arbitrary and you may be out of competition. So today we have to be very judgmental. We have to balance it off. We can't just do it. We have to be very careful. In the marginal cost in pricing, we don't take the overhead, so we don't have a total cost. We look at the profit margin. We look at the variable cost, and from the variable cost, when from the sales minus variable cost, that is what we call the contribution. Now, this contribution should be good enough to recover your fixed overheads plus a profit. Right? So the sales minus variable cost, you are going to get what we call a contribution. In the absorption costing, sales minus total cost, you get your profit. But here, variable cost is only recovered. So from the contribution, we must recover the fixed overheads also, then only profit will come. So the contribution minus fixed overheads is your profit in the marginal cost. So The marginal costing is good for short-term decision making, and also it will give us a kind of a way for us to allocate the what we call scarce resources. So to this is something what we use to maximize the contribution. We will use the scarce resources. So that again, we will look at certain questions and try to understand it much better. So the criticisms for marginal costing is basically it ignores the total calculate total overhead. It ignores the competition. It ignores the customer requirements, and also it's good for short-term decisions, but surely not good for long-term decisions because you might go on recovering your variable cost without thinking about your overhead cost at all, and you might end up with big losses at the end of the day. Total costing, you will never miss the mark because you have included all your costs to be recovered. Okay, so with that, we have come to the end of the first part of our area. So I'll send this recording for you, uh, and you can just go through, and we will move into the next area, and we will look at some questions also before we move into the next area. How are you tomorrow? Are you free to do tomorrow?
Yes, tomorrow 9.
9 o'clock. Shall we do tomorrow also? Then we can finish up some areas. Yeah. Okay. So I'll see you tomorrow at 9 o'clock, Asanga.
Okay. Yeah. Thank you very much.
Okay. Thank you. Take care. Bye.